In 1983, 13 people with little trading experience received 2 weeks of training. Published rules say the group averaged 80% a year for 4 years. That is the legend. But could a normal investor copy it today? Turtle trading was not one line on a chart. It answered 6 questions: what to trade, when to enter, how much to buy, where to cut a loss, when to add, and when to leave a winner. Remove one piece, and you're testing a different machine. Here is System 2 in plain English. Watch many markets. When one pushes above its highest price of the last 55 trading days, buy. If it breaks the 55-day low, bet on a fall. Buy less when that market jumps around, and more when it moves quietly. Cut the trade after 2 normal daily moves against you. Now a real example from our test. Oil broke above $58.69 on January 12, 2022. The rule bought 1 block, then added 3 more as oil kept rising near 59.42, 60.36, and 61.25. There was no profit target. When oil fell through its 20-day floor in June, the trade closed near 78.75 after costs. The dollars deployed made about 33%. The original turtles traded futures, bonds, currencies, gold, silver, copper, oil, gasoline, sugar, and the S&P 500. We do not have trustworthy continuous futures history, so we will not pretend to replay the legend. Instead, we fixed 16 matching ETFs before seeing the results and ran them from June 2015 through May 2026. The first lane is simple enough for a cash account. Buy only, never borrow, never add, and never invest more than the account value. The second lane puts falling price trades and 4-step additions back in, caps total exposure at twice the account, and charges trading, borrowing, and shorting costs. Both lanes trade the same fixed markets and see no future data. Put $100,000 into the simple turtle lane and another $100,000 into SPY, the fund that owns about 500 large US companies. Teal is turtle, white is the market. We start close. For years, the breakout account mostly drifts while SPY compounds. By the end of 2019, turtle is still below its starting value. Then the pattern appears. The 2020 silver trend helps. Energy trends help in 2022. But by the end of 2024, the account has still made only 3.62% a year. The last jump comes from a few huge silver, oil, and gasoline trades in 2025 and 2026. At the finish, the simple version turns $100,000 into about $230,000. SPY reaches about $429,000. That is 7.85% a year versus 14.16%. Turtle falls less in its worst period, 22.7% versus 33.7%, but the smaller drop does not make up for the missing wealth. Now put the missing pieces back. Adding to winners turns 7.85% into minus 3.06%. Adding falling price trades without additions finishes near flat. The full ETF reconstruction, with falling price trades and 4 blocks, loses 6.25% a year. Even when we erase every trading and borrowing cost, the full version ends almost exactly where it began. That does not prove the turtles failed. It proves the market and trading vehicle matter. Futures supply cheap leverage, different trend behavior, and more opportunities. ETFs force position caps and carried fund fees plus contract replacement effects. And this test started 32 years after the original experiment. The same entry line does not make the same strategy. The simple version also shows why trend following is hard to live with. Its 5 best trades produced 84% of all trade profit. Without those 5, it still made money, but most of the decade felt disappointing. Our narrow verdict, the 55-day breakout survived as a lower drop ETF rule. The famous complete system did not transfer cleanly, and SPY built almost twice as much wealth. On our return board, the clean long-only translation lands at 7.85% a year, below its matching market return. If you use trend following, tell us the exact markets, entry, risk, and exit rules in the comments. We will test the rules you actually use.